Gold plunged by $200 in a single week. Not because global risks eased, not because inflation disappeared, not because the Federal Reserve suddenly decided to cut rates. Gold fell because Brent crude surged past $111 per barrel. In April, inflation printed at 3.8%, the highest since May 2023, while the 10-year Treasury yield jumped to 4.6%. Consider that sequence for a moment. Each of those figures signals alarm for gold. Yet, the financial media claims the gold rally is over. That narrative is misleading. Here is what truly unfolded this past week. The Bureau of Labor Statistics released the April 2026 Consumer Price Index report on May 12th. Headline inflation came in at 3.8% year over year. That is 0.5% above March and exceeded every analyst projection on Wall Street. Energy contributed more than 40% of that monthly increase. Gasoline rose 28.4% in a single year. Food at home experienced its largest monthly jump since August 2022. Real wages, the actual purchasing power of paychecks, turned negative for the first time since 2023. When the CPI data was released, traders at CME Group removed every remaining rate cut from the calendar. Bank of America now expects the Federal Reserve will not cut rates until July 2027. JP Morgan projects inflation will not return to the Fed's 2% target before early 2027, regardless of developments in the Middle East. We are looking at a full year of structurally elevated inflation with no relief from the Fed. So ask yourself, if inflation runs at 3.8%, real wages are negative, oil is above $111 per barrel, and the Federal Reserve is inactive, why would gold fall? Gold is fundamentally a hedge against precisely this scenario. Yet it did decline. This is not a market moving according to fundamentals. Financial media explanations claim gold fell because the US dollar strengthened, or because rising Treasury yields make gold less attractive since it produces no yield. They suggest investors rotated into bonds to capture the 4.6% return on the 10-year. They frame it as rational, orderly market behavior. The rally supposedly ran ahead of itself, making it time to take profits. That reasoning seems plausible. The dollar did tick higher, and yields did rise. In theory, rising real yields create pressure on gold. That argument makes sense in textbooks, but it misses a crucial factor. It overlooks the short-term mechanism driving gold prices. The gold price displayed on screens is not determined by the physical market. It is set by the COMEX Futures Exchange in New York, a paper market where most contracts settle in cash, not physical metal. On any trading day, the total gold represented by open COMEX contracts can surpass the registered physical gold available for delivery by huge multiples. That gap between paper and physical is where manipulation occurs. Here's the sequence to understand. Oil jumps above $111. The inflation delta prints hot. The dollar strengthens. The 10-year yield spikes to 4.6%. That combination forms a short-term narrative, a hawkish Fed, a stronger dollar, less interest in non-yielding assets. On Wall Street trading desks, retail investors do not see this narrative, use it. Clearing banks with the largest short positions on COMEX add to their shorts, pushing the paper price down. They rely on retail investors to act predictably, selling physical positions at precisely the wrong moment as the big players prepare to cover. Covering means these banks hold massive net short positions on gold futures. They have a strong financial incentive to push the paper price lower. Eventually, they must close those positions, buying back the contracts sold short. The lower they drive the price before covering, the more profit they secure. The only time the price moves far enough is when retail investors panic and sell. They need that fear and effectively manufacture it. The physical market tells a different story. In the first quarter of 2026, total gold demand reached 1,231 tons, valued at a record $193 billion. That represents a 74% increase in dollar value year over year. Bar and coin demand alone rose 42% to 474 tons, the second highest quarterly total ever recorded. Central banks added 244 tons in a single quarter. The World Gold Council calls it a seminal moment when the paper price fell. This week, physical buyers did not retreat. They bought the dip at the prices set by the banks. Meanwhile, the Strait of Hormuz remains blocked. Iran and the United States continue deadlocked. Please leave your thoughts about this content in the comments below. Thanks for watching. See you in the next one.